Hi. I'm Olivia, a custody advisor at Wall Street Prison Consultants. Today we're going to discuss mortgage fraud. Mortgage fraud is a federal offense that occurs when an individual or group of individuals use intentional misrepresentations or omissions to induce the funding, purchase, or insurance of a mortgage loan, or the terms relating to it. It is not criminalized by a separate federal statute, but charged under a theory of bank, mail, or wire fraud. To prosecute mortgage fraud, the government must prove beyond a reasonable doubt that the person charged with mortgage fraud acted with intent to defraud, devised or participated in a scheme intended to deceive and gain financial advantage, or obtain property or money through false representation. Secondly, the information on the mortgage application and supporting documents must be materially incorrect and important enough that it would have led the lender to either reject the mortgage application or make some other materially different decision. And the perpetrator used either the U.S. mail system or electronic communication, such as a text message, email, or fax, to carry out the scheme to defraud through false representations. Mortgage fraud falls into two categories: fraud for profit and fraud for housing. Fraud for profit is committed by real estate professionals like appraisers, agents, brokers, and other industry insiders, with the intent to take money from a property or transaction. Offenders often collude with other industry professionals and misuse the lending process to take advantage of lenders or homeowners during the lending process. Fraud for housing occurs when a borrower submits inaccurate or incomplete information in order to qualify for a loan or obtain better terms by misrepresenting their income on a loan application. Common types of fraudulent mortgage schemes include appraisal fraud, where the appraisal of a property for a mortgage loan is intentionally either overstated or understated. Some loan officers or brokers collude with property appraisers to have appraisal values inflated. A potential borrower sometimes colludes with a dishonest appraiser in order to commit appraisal fraud. The borrower is then able to obtain a mortgage loan for more than the amount necessary to purchase the property. Occupancy fraud occurs when a prospective borrower states they intend to occupy a property as their primary residence in order to obtain the most favorable loan terms when they do not intend to live in the property. Loans on primary residences are typically granted with lower interest rates. Straw buyer fraud occurs when an investor uses a fake buyer, credit reports, and false income reports to obtain property when the buyer may not qualify for a mortgage or the best possible interest rates. They then have the fake buyer sign over the property to them after closing. In many cases, they also make no payments on the property, but rent it until it is foreclosed. Income fraud is the most frequently occurring type of mortgage fraud. It consists of a potential borrower stating an income amount that is higher than they actually make using fake support documents, such as submitting altered paycheck stubs, forged documents, or other fraudulent documentation to better their chances of obtaining a loan. Other fraudulent tactics include a borrower claiming self-employment income that does not exist, or listing a false job title. Sometimes mortgage brokers or lenders are the perpetrators of mortgage fraud schemes and may approach homeowners who are in financial difficulty with a mortgage rescue scam. They convince the homeowner to temporarily transfer the property to them, promising to make the mortgage payments on it until the homeowner can resume doing so themselves. Rather than doing as promised, the brokers then sell the home right out from under the actual homeowner and disappear with the profits, as well as having charged the homeowner a fee for their services. As stated above, federal mortgage fraud charges can be brought against anyone involved in a mortgage fraud scheme, including borrowers, bank officers, appraisers, mortgage brokers, and other real estate professionals. Whether you are being charged as a home buyer or an industry professional, the burden of proof in a mortgage fraud case lies with the prosecution. In order to get a conviction on charges of mortgage fraud, the prosecution must prove beyond a reasonable doubt that you deliberately engaged or attempted to engage in mortgage fraud, with possible defenses being: you have been falsely accused of mortgage fraud. The prosecutors have insufficient evidence to warrant a conviction. You provided true, correct and accurate information on your mortgage loan application and/or you were acting in good faith and did not intend to break the law. Because mortgage fraud can involve a wide range of illegal acts, the potential penalties for mortgage fraud will vary depending on the specific facts of the case. The following are some of the statutes that the federal government can use to prosecute mortgage fraud, as well as their associated penalties. Conspiracy: 18 U.S.C. Section 371 up to 5 years in prison, plus a potential fine. Making false statements on a loan or credit application: 18 U.S. Code Section 1014 up to 30 years in prison, or up to $1 million in fines, or both. Wire fraud: 18 U.S.C. Section 1343 up to 30 years in prison, or up to $1 million in fines, or both, if the fraud affects a financial institution; otherwise, up to 20 years in prison. Mail fraud: 18 U.S.C. Section 1341 up to 30 years in prison, or up to $1 million in fines, or both, if the fraud affects a financial institution; otherwise, up to 20 years in prison. Bank fraud: 18 U.S.C. Section 1344 up to 30 years in prison, or up to $1 million in fines, or both.